Stock Market for Beginners. Section 1, The Basics. Why investing matters. Investing is an effective way to put your money to work and potentially build wealth. Smart investing may allow your money to outpace inflation and increase in value. Investing has a better chance of making money grow because of the power of compounding and the trade-off between risk and return. The power of compounding. Compounding happens when earnings or dividends from an investment are put back into the same investment. These profits or dividends then bring in more money on their own. In other words, compounding is when your investments earn money based on the money they have already earned. If you buy a stock that pays dividends, for example, you might want to reinvest the dividends to take advantage of the potential power of compounding. The risk-reward trade-off. There are different levels of potential return and market risk for each type of investment. Risk is the chance that an investment will give a lower return than expected or even lose value. Return is how much money you make from the assets you've invested or how much the overall value of the investment goes up. For example, putting money into stocks could give you a higher return. Investing in a money market or savings account, on the other hand, is less risky than investing in stocks, but you probably won't get as much money back. How much risk you take depends on how much you like or can handle risk. You are the only one who can decide how much risk you are willing to take in order to make more money. But if you want your savings to grow faster than inflation, you may need to take some risks. To get the most out of compounding, start investing as soon as possible and have your dividends and other distributions automatically reinvested. What is a stock? A stock is a unit of ownership in a company. If you own a stock, you are a shareholder, which means you may be eligible to receive dividends if the company succeeds, and you may have the right to vote on certain company decisions. Stocks are an important part of the global economy because they let companies obtain money to run their businesses by selling shares to the public. You can buy or sell shares on an exchange, like the New York Stock Exchange or NASDAQ, through an online stockbroker. Why buying stocks can be a good investment. Over time, the stock market has helped people make a lot of money. Putting money into stocks, or the S&P 500, which is made up of 500 of the largest publicly traded companies in the U.S., has returned between 8% and 12% per year on average. If you had put just $10,000 in the stock market 50 years ago, it would now be worth more than $380,000. But keep in mind that the stock market doesn't always go up. About 3 times every 10 years, the S&P 500 falls. Some drops can feel really bad, and not everyone likes how volatile it is. But if you can get over your fear, stocks have the potential to give you much higher long-term returns than other investments. Advantages of putting money into stocks. Putting money into stocks has a lot of benefits. The 7 big ones are: 1. The chance of making more money. Most people invest in stocks because they have a better chance of making money than other options like bank certificates of deposit, gold, and treasury bonds. For example, since 1926, the average return on the stock market has been about 10% per year, while the average return on long-term government bonds has been between 5% and 6% per year. 2. Being able to keep your money safe from price inflation. Most of the time, the returns from the stock market are much higher than the rate of inflation. For instance, since 1913, the long-term inflation rate has been about 3.1% per year. That's like a double-digit return on stocks every year. Investing in stocks has been a good way to protect against inflation. 3. The ability to make regular money without doing anything. Dividends are a way for companies to share some of their profits with their investors. Most companies pay dividends every 3 months, but some pay dividends every month. Dividend income can be a nice addition to an investor's salary or income from retirement. 4. Taking pride in what you own. A share of stock is a small piece of a company's ownership. You can own a small piece of a company whose products or services you love. 5. Liquidity. Most stocks are traded openly on a major stock exchange, which makes buying and selling them easy. It also makes stocks a better investment than other options like real estate, which you can't sell quickly. 6. Diversification. With stocks, it's easy to build a portfolio that has investments in many different fields. They can help you spread out your investments, which could also include real estate, bonds, and cryptocurrency, lowering your overall risk while improving returns. 7. Being able to start out small. Investors can start buying stocks with less than $100 because many online brokers don't charge commissions and let you buy fractional shares. Risks of putting your money in stocks. Now that we've talked about the pros of investing in stocks, let's talk about the cons. The biggest risk of investing in stocks is stock market volatility. On average, the stock market falls 10% from its high every 11 months, 20% every 4 years, and more than 30% at least once every decade. You might not want to buy stocks because of the following. You can't stand the idea of your investment going down by 10% or more. Within the next 3 to 5 years, you'll need the money for a down payment on a house or another big purchase. You're retired or getting close to retirement and need a steady income more than the chance that your stocks will go up in value. Why should you invest as soon as possible? There are some good reasons not to buy stocks, but for most people, the upside potential is worth the risk. So, investing in stocks is almost always a good idea, even when the market is at an all-time high. Studies have shown that the amount of time an investor spends in the market is more important than how they time the market. It can be expensive to wait for the right time to buy stocks because most of the gains come from a small number of days. Stocks, on the other hand, tend to bounce back from corrections or drops in earnings of more than 10% in a few months. The less likely it is that an investor will lose money the longer they stay in the market. Choosing the right stocks to buy is just as important. It doesn't matter when you invest if you invest in great companies. Most of the market's overall return comes from a small number of stocks. That's why it's better to buy stock in a great company as soon as you can instead of waiting for a better price that might never come. What is a stock exchange? A stock exchange is a place where stocks, bonds, and other types of securities can be bought and sold. It gives companies a place to sell stocks and investors a place to trade those stocks with each other. This all happens in a regulated space that tries to make everything as quick and clear as possible. Around the world, there are many stock exchanges, and each one serves a different market. For example, the NYSE is one of many stock exchanges around the world, but it's also the biggest based on its market capitalization, which is the total value of all the stocks that are traded there. In the past, stock exchanges were mostly places where men stood on the floor and shouted buy and sell orders. Most exchanges happen online these days, with computers putting together buyers and sellers. The NASDAQ is a great example of an electronic exchange that began operations in 1971. How do stock exchanges make money? For example, the NASDAQ is a global electronic market where many of the world's biggest tech companies, like Apple and Google, are listed. The NASDAQ has a number of linked services that cost money to use. Large tech companies pay different fees to be listed on the exchange, and individual investors pay transaction fees to buy and sell securities. The NASDAQ Inc.'s 4 main lines of business and how they make money are: corporate services. Companies that want to list on the NASDAQ have to pay fees. Info services gives users different market data and research to help market participants learn more. Brokerage and clearing services fees are added to all trades. Services related to technology, such as investor relations, public relations, and governance. What is an index? An index is a standard way to keep track of the performance of a group of assets, like stocks. Indexes usually track the performance of a group of stocks that are meant to represent a certain part of the market. For example, the S&P 500 index tracks how about 500 of the biggest publicly traded companies in the U.S. do on the stock market. The index is made up of the top companies in the top industries. It is capitalization weighted, which means that each stock is given the same amount of weight as its market value. For example, a company with shares worth $100 billion is given more weight than a company with shares worth $10 billion. What is an index fund? Index funds are investment funds that track a benchmark index, like the S&P 500 or the NASDAQ 100. When you put money into an index fund, that money is invested in all the companies that make up the index. This gives you a more diverse portfolio than if you bought individual stocks. Index funds aim to hold the same stocks as the index they follow. Because of this, they are naturally diversified and have less risk than holding individual stocks. Market indexes have also done well in the past. Even though the S&P 500 does change, in the past it has given investors an average annual return of almost 10%. Index funds are an easy way to invest with low fees. It might be the smartest and easiest investment you ever make. Warren Buffett, one of the greatest investors ever, famously said, "In my view, for most people, the best thing to do is to own the S&P 500 index fund. People will try and sell you other things because there's more money in it for them if they do." Index investing is a form of passive investing. Investors in an index fund don't have to manage their stocks and bonds as closely because the fund just copies an index. This is why index funds are called passive investments and why they are different from mutual funds. What is a mutual fund? Mutual funds are a form of active investing. Mutual funds are actively run by people called fund managers who choose how your money is invested. The goal with mutual funds is to beat the market, while the goal with index funds is simply to match the market's performance. Since mutual funds are managed by a person every day, their fees are higher, so by investing in index funds, you can save lots of money in the long term and in turn help you make more money. Mutual funds are companies that take money from many investors and invest it in stocks, bonds, and short-term loan debt, and are popular with pension plans. Investors buy shares in mutual funds, and each share represents an investor's part of ownership in the fund and the income it generates. Mutual fund trades are executed once a day at a single price. What is an ETF or exchange-traded fund? Similar to mutual funds, an exchange-traded fund is a sort of pooled investment vehicle. ETF often track a particular index, sector, commodity, or other asset class. However, unlike mutual funds, ETF can be bought and sold on a stock exchange in the same manner as common stocks, and trades can be executed many times a day at different prices. By combining the diversification advantages of mutual funds with the simplicity of stock trading, ETF provide investors with a straightforward means of accessing the global financial markets. An ETF can also be designed to track the price of anything from a single commodity to a wide portfolio of securities or investment strategies. There are many categories of ETFs such as stocks, bonds, sector and industries, and commodities. The list on the right is some of the best performing ETF over a 5-year period. Congratulations! You have completed Lesson 1. I hope you have enjoyed the first tutorial video in this complete Guide to the Stock Market for Beginners video series. Make sure to like and subscribe to never miss a video in the series, and leave a comment about where you are watching from. See you on the next video.